In a word, it's probably been a little bit bruising. I certainly wasn't expecting a great set of results, particularly with the backward-looking nature of our reporting season. If you look at where our economy's at, we are in a pretty dire state. So you don't expect good results or very strong results from our corporates in that backdrop. And that's what we got, some pretty weak backward-looking results. The thing that probably surprised me is that there was a real lack of acceptance from investors of those soft results. And I think that came because the outlook statements, which is where I was hoping to see some positivity, were still a little bit muted. There was lots of companies saying, hey, we've seen the interest rate cuts. We expect they will benefit us in the future. But nobody could really tangibly come out and bang the table and say, we're already seeing those green shoots. Things are starting to turn for our business. There was none of that, and I think that's what investors were really looking for. So a little bit of disappointment to go away. Our economy has been one of the weakest when we compare to most developed nations around the world. Our high interest rates have really put the brakes on. We're now seeing a reversal of that, and I genuinely think the big question now is, are we confident that the second half of the year is going to see some positive momentum for our economy? And I think we definitely are going to see ourselves lift off the canvas, and as that happens, I expect to see our earnings results pick up, but we probably won't see that evidence until the August reporting season, which is still some time away. That's still 6 months to wait. And I think what you're seeing right now at the moment is that investors are just becoming a little bit impatient, and that's where you're seeing some share price falls. Yeah, these are the ones that always get my heart racing, is the unscheduled ones that we aren't expecting, and most of the time they are bad news. Luckily, it was a mixed bag this time. We got some positive and some negative news out of those companies. So 3 to cover off here. Manawa Energy downgraded its earnings by about 15%, and they blamed most of that on the dry and calm conditions we've seen recently. So if you've been out enjoying your summer break, you go, geez, we want it to be dry, we want it to be calm. But when you rely on the water and the winds to generate your electricity, and there's not an abundance of that like we've seen in the last couple of months, then that makes things really tricky. So Manawa had a pretty sizable downgrade there. The other big downgrade came from Heartland Bank or Heartland Group. In their New Zealand business, they've taken a $50 million write-down, and that's largely in their motors lending and in their small business lending books. And again, just reflects how tough the economy is out there, and some consumers ultimately, whether it's small businesses or those that have taken motor vehicle loans, are struggling to pay those back. And Heartland has looked at some of its book and gone, we don't think we're going to recover this, so we have to take a write-down. That'll impact their profit for this year pretty substantially, and they expect that things should start to improve from then onwards. In contrast to those two, Turners Automotive reported improving performance across all its divisions and a profit upgrade, which is phenomenal in the environment that we're in. The company's on track to now hit its 5th consecutive record annual profit, which is just outstanding. And it shows that even in this tough environment, companies with a smart strategy, a good marketing campaign, we all know about Tina from Turners, they can still do well. So it does come down to a little bit of, can you control your own destiny? And Turners is clearly doing that. So big ups to them for doing that in what is absolutely a tough environment when we hear from most other corporates at the moment. Yeah, so if we're going off just share prices, the best one of the lot so far that we've seen is A2 Milk. Looks to have really good momentum into that Chinese market at the moment. They lifted their full year revenue guidance, and it appears some of the cost drag that we've seen over the last 6 months has started to disappear. The business is now paying a dividend, which is great for investors. They've also got $1 billion just sitting around on the balance sheet. So we expect that they will either use that for a bit more M&A, some opportunistic acquisitions, or they will look to do some shareholder-friendly stuff, whether it's a special dividend, share buybacks. Expect more positive news from them throughout the year. The other ones which saw some good share price reaction was Freightways. Just another outstanding result from them in what is a tough operating environment. Revenues and margins up around 7%. Still that tough backdrop. So the same customer volume, so that's their existing customers, were down, but they're managing to win market share, so new customers, and they're putting through some price rises, which is driving the earnings and revenue to be a little bit higher than it was this time last year. The outlook, I always keep an eye on what they say, and they're talking about a slow grind for New Zealand. So things are improving, but it is very, very slow for someone like Freightways at the moment. But it just shows how well they are doing operationally in their own business. And then finally, the surprise one in the package of stocks that bounced on the day was Fletcher Building. Now, earnings were down over 30% for the first half result, and the stock went up. And I think a lot of that was to do with the fact that there was no bad new news, if that makes sense. So, there was no further deterioration in the operations of Fletcher Building, and the stock's been under so much pressure. I think there was a little bit of a relief rally there, but lots of water to go under the bridge for that business, and a lot to do before we can talk about earnings actually rising for Fletcher Building. In terms of share price falls, and the first one is the one that is probably the head scratcher, EBOS Group. Good result, maintained their guidance for the full year, and on track to actually deliver a really strong full year number, but the stock fell about 5%. And I suspect part of that to do with the CEO announcing that he is leaving, and he's highly regarded. But I think also because the stock had run up so hard into the result, there was a bit of profit taking from people and investors who saw that momentum has started, and most of it's in the share price now, so they took a bit of profits there. Two genuine poor results which saw a big share price reaction were Sky City. So weak first half result, earnings are down 20%. Again, an economically sensitive business, no surprises, but hard to see light at the end of the tunnel at the moment for that business. And the big one that's probably, I think, the worst result we've seen so far, and a real disappointment, is Spark. It's the gift that keeps taking at the moment, to be honest. Another 5% earnings downgrade for the full year. It's certainly fallen out of favour, and it's got a whole host of things to do to get investors inspired in the business again, and lots of uncertainty over the next little while. Too much to mention on this video, but yeah, a real disappointment and a long road ahead for them to rebuild that investor confidence. Yeah, so we had our first OCR decision last week as well, the first after the long summer break. And the Reserve Bank, under no surprises, decided to cut by 0.5%. So we now have an OCR that sits at 3.75%. From here, I think the key things to note are that there are still going to be some more cuts. They are going to be more gradual, so probably a couple of 0.25% cuts, and that'll take us to around 3.25%. And that's probably where neutral is for our economy at the moment. I think that's what you'll see the Reserve Bank do over the next couple of meetings, is small bite-sized cuts, and then they'll wait and see if that's enough to lift the economy off the canvas. If the data doesn't improve and doesn't behave, there is clearly opportunity for them to cut further, but I don't think that's going to be the base case for what Adrian Orr and the Reserve Bank want to do. So a little bit more relief to come for those of you that are mortgage holders over the coming months, but don't expect too much more heavy lifting from here. I think most of the big cuts are already there, and your mortgage rates are probably reflecting close to what is going to be the best in the short term. Yeah, so the show still goes on. Another busy week coming up. We've got around 20 companies reporting their results this week. This is the last week of reporting season, so last chance to hear from everyone for a little while. We've got a couple more electricity companies, Mercury and Meridian. That'll be interesting because, most of that sector, which is generally stable, has had to navigate some pretty volatile electricity markets with dry periods and then really wet periods. That makes things quite tough for them. So it'll be interesting to hear how they've navigated that, and also what the development pipelines look like over the next 3-5 years, because that has a real influence on the electricity sector, but also all of us around New Zealand who pay our electricity bills to these big four companies for the most part. Some of our primary sector exporters, I'll be keen to hear from them. Delegate Group and Scouts Corporation will be the two that we hear from later this week. Always lots of variables in that sector, aren't there? Whether it's harvest quality, the weather, the currency, labour availability. Now we can add tariff uncertainty to that as well. So keen to hear from those companies about what they're seeing out there, how tangible some of those risks are, and where the currency movements are going for them. Does that help them? Does that hinder them? So that'll be interesting. And I guess sticking to that primary sector and export space, Port of Tauranga, always keen to keep an eye on that one. Moves a lot of our exports. It's a great barometer for our economy in the primary sector, and it's got some big growth projects that it's trying to get over the line. So plenty to talk about for that company. I think it should hopefully have a reasonable set of results after what was a tough start to the year for them. So that's one we'll hear from in not too distant future. And then you've got Tourism Holdings, Somerset, Chorus, a few others. So plenty to digest. I still think this week is going to be very much like the last. Lots of volatility. Investors are going to be on edge, and any poor results are going to be punished pretty hard. Of the companies that reported last week, remember, only about a third had a positive share price reaction on the day that they reported. So things are tough out there. Investors are reasonably unforgiving at the moment. The question we need to get our head around is, are we now at the bottom of this economic cycle? Is this as bad as it gets? And if it is, then earnings should start to improve as 2025 progresses throughout. So these share price falls, if your view is that this is as bad as it gets, those share price falls could present a good buying opportunity. If your view is that, geez, things aren't going to turn, regardless of the big interest rate cuts, regardless of everything else going on, I don't see the economy turning for the next 6 to 12 months, then those share price falls are probably a little bit justified. I certainly sit in that glass half full camp. I think this is we are at the worst part of it, and those interest rate cuts will come through. It will drive the economy, and we should start to see a lot of our earnings start to improve as the year progresses.
For more insights, visit craigsip.com.